Types of lenders and mortgage process. With mortgages, the primary market is the signed and approved loan between a home buyer and a mortgage lender. Once a loan has been approved and a property purchased, the lender can then sell that mortgage to other prospective buyers on the secondary market, or stock exchange. Since a single loan doesn't hold much value in and of itself, lenders package loans together which are then rated based on the quality of the loans therein and put on the secondary market for investors. Unattractive loans aren't a great investment on the secondary market for obvious reasons. Who wants to buy a risky or subpar investment? Furthermore, if a loan goes into default or is called or accelerated within the first year of originating, an originator might have to repurchase the loan from the secondary market, which is the last thing a lender wants to do. So the terms that a lender sets with an individual borrower are influenced by how attractive and safe the loan will be on the secondary market. A mortgage issued to a borrower with great credit, a high, stable income, and little debt is a far more attractive loan on the secondary market than one issued to a borrower with poor credit, lower and less stable income, and high debt. It's important to understand that the lender, then, is setting terms based on two key factors, one that's fairly apparent to the borrower and the other not so much. Factor 1. How likely is it that the borrower can repay this loan? Factor 2. How likely is it that the lender can sell this loan on the secondary market? Understanding this process and the factors that drive lender inquiries into one's personal finance will help them better prepare for the application process and also help them determine the best lender to approach based on their particular needs and circumstances. Types of lenders. Often we think of mortgage lenders as one big entity, some big banking blob that accepts or rejects mortgage applications. But there are actually many types of mortgage lenders that have slightly different roles, motives, and processes. Being able to make these distinctions can mean the difference between signing for better or worse terms, or even getting a mortgage at all. Mortgage lender versus mortgage broker. Perhaps the biggest and most significant distinction to be made is between mortgage lenders and mortgage brokers. There is a wide range of mortgage lenders, but the primary thread that ties them all together is that lenders are financial institutions that all have the capacity to underwrite and finance a mortgage. A mortgage broker, on the other hand, is not a financial institution, as big a role as they play in the mortgage industry. They don't actually lend anything. Rather, mortgage brokers are intermediaries between the borrower and the lender, and their role is to get a deal done, or broker a deal, between the two parties. Mortgage brokers work much like real estate brokers. They try to forge a deal between two parties with a mutual interest. In real estate, brokers bring together home buyers and home sellers. In mortgage finance, brokers bring together borrowers and lenders. Mortgage brokers don't work exclusively with one lender, they work with many different lenders. They collect the financial information from a prospective borrower, and then shop around with different lenders to try to find that borrower the best terms. The goal of the broker is to find a match, in which the lender is willing to issue a mortgage with terms the borrower is willing to accept. Once that match has been made, the broker's primary role is finished. They then might help facilitate the process between lender and borrower, but ultimately the deal is finalized between the two primary parties, the borrower and lender. It's worth noting that some brokers are permitted to underwrite loans originated on behalf of lending institutions, otherwise known as delegated underwriting. Often these brokers will have underwriting overlays on top of the predetermined guidelines set out by the primary lenders. How brokers get paid. As with a real estate broker, the mortgage broker will get a fee for brokering the deal, often 1% of the overall loan amount. This fee can be paid by either the borrower or the lender, so it's important that your client understand this and inquire who's responsible for paying the fee. But even if the lender is said to be paying the broker fee, the cost might still be passed on to the borrower in the form of a higher interest rate than they might otherwise have received. This is why it's important that you emphasize to clients that they should shop around not only with more than one broker, but also more than one lender, so clients are clear on what the best terms are for their particular situation. There are various types of lenders, each offering different types of loans and financial products to individuals, businesses, and governments. The main types of lenders include 1. Commercial banks. These are the most common type of lenders. They provide a wide range of financial services, including savings and checking accounts, personal loans, mortgages, and business loans. 2. Credit unions. Credit unions are member-owned financial institutions that offer services similar to commercial banks, often with a focus on serving a specific community or group of people. They typically offer competitive interest rates on savings and loans. 3. Online lenders. Online or digital lenders operate solely through the internet. They provide various loan options, such as personal loans, small business loans, and student loans. These lenders often have quick approval processes. 4. Mortgage lenders. These lenders specialize in providing home loans or mortgages. They can be banks, credit unions, or specialized mortgage companies. 5. Peer-to-peer lenders. Peer-to-peer lending platforms connect individual investors with borrowers. These platforms facilitate personal loans, business loans, and other forms of financing. 6. Payday lenders. Payday lenders offer short-term, high-interest loans, typically to borrowers who need quick cash and may not have good credit. These loans often come with very high fees and interest rates. 7. Microfinance institutions. Microfinance lenders provide small loans to individuals, particularly in developing countries, to help them start or expand small businesses and improve their economic conditions. 8. Credit card companies. Credit card issuers provide credit cards with revolving credit limits. When you use a credit card, you are essentially borrowing money from the card issuer. 9. Private equity and venture capital firms. These investors provide funding to businesses, often in exchange for equity. They are more focused on equity investments and funding startups and growing companies. 10. Government lenders. Government entities, such as the Small Business Administration, SBA, in the United States, provide loans and guarantees to individuals and businesses for various purposes, such as small business loans or student loans. 11. Non-bank financial institutions. These include finance companies, leasing companies, and other specialized lenders. They offer loans for specific purposes, such as auto loans or equipment financing. 12. Pawnshops. Pawnshops offer loans in exchange for valuable items like jewelry, electronics, or musical instruments. If the borrower fails to repay the loan, the pawnshop keeps the item. 13. Family and friends. Borrowing from family or friends is a common informal lending option. It's important to approach such arrangements with clear terms and understand the potential impact on personal relationships. 14. Corporate bonds and bondholders. Large corporations can borrow money by issuing corporate bonds, which are bought by investors. Bondholders lend money to the company in exchange for periodic interest payments and the return of the principal amount at maturity. Each type of lender has its own advantages, disadvantages, and eligibility criteria. Borrowers should carefully consider their financial needs, creditworthiness, and the terms offered by various lenders before choosing the best option for their circumstances.